The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Can everyone see my screen and can everyone hear me? If you would just type in a yes or a no, I would appreciate it. Good morning, Jason. Now, this morning we're going to be trading the Bank of Canada rate announcement. And before we get started, I want to make sure everyone has a moment to read over the Nadex risk disclaimer. Basically, anytime you are trading, there is risk involved. And of course, you can always lose money. So therefore, you should never trade with money you cannot afford to lose. I also want to remind everyone that this is an educational webinar and you should treat it as educational, okay? Now, the main thing about trading market reports is all about choices. You can have a bias to the long side. This is a directional trade. And you simply buy the binary or the spread. Additionally, you could have a bias to the short side. In other words, you think the market is going to go down. In that case, you would sell the binary or the spread. You also have what's termed a volatility-based bias. That means really you don't care whether it goes up or down. You just want it to move. In that case, you could buy and sell either the binaries or the spreads, and you have a limited risk on both. So what's the difference between a directional versus a volatility trade? Well, directional, you really choose one direction and you go with that. You have risk on only one trade, which is your directional trade, and your profit would be the payout versus or minus the risk that you paid on entry. Does everybody understand that? So for example, let's say you opted to go long on a binary, okay? You paid $20 a risk. The binary expires in the money, so you make $80. That's simple, okay? Or it expires out of the money and you lose the $20, okay? A volatility-based trade, you don't choose a direction, okay? Instead, you go both long and short using either binary spreads or a combination of the two. Now, this does increase your risk because you have two trades instead of one. So, for example, if the market doesn't move at all, you could actually lose on both of your trades, okay? You really need that movement for a volatility-based trade, okay? For example, if you go long on a binary with $20 of risk and you're short on the spread, you have a total of $30 at risk. Now, you could lose on both of those because the market could not move at all, okay? But then again, it could expire in the money on the long, which you would make $80 because it was a binary. The maximum payout is $100, but you have suffered a $10 loss on the short. So therefore, your actual profit is only $70. Does everybody in the room understand the difference now between the directional and the volatility trades? Now remember, when you're trading a market report, anything can happen, okay? Using the 10 to 10:15 15-minute bar, the average move for the Bank of Canada rate announcement is 80 pips. Now, sometimes it can be more, sometimes it can be less. In other words, the market may not move at all, okay? Now, before we look at the trades this morning, I do want to give everyone my contact information. My website is tradershelpdesk.com and my email is gm@tradershelpdesk.com. So let's go and look at some trades that I have already placed today. And let's look at the differences between them. Okay. I'm going to bring over the USD Canadian 15-minute chart. Okay. And you can see that the last 4 bars have been bullish, but we now have a bearish bar. Okay. So maybe you say, okay, I've got a bias to the short side. Now, if you have a bias to the short side, you could actually do any of these shorts. For example, you could short the 126.50 to 129.00 spread, which is a daily. You could also short the 1.2810 to 1.2910 spread that expires at 11 a.m. You could also choose to short the 2860 area or the 2879. What's the difference between those two? The biggest difference is this is a 2-hour binary. This is a daily. This is a 2-hour spread. This is a daily spread. Okay? That would be directional if you had a short bias. Does everybody understand that? What if you had a long bias? If you have a long bias, then you could do any of the long positions, okay? So for example, you could go long on the 2900 to 3150 spread that expires at 3 p.m. You could also do the 2910 to 3010 that expires at 11 a.m., okay? Or you could do a binary for 29.49 or 29.60. Both of these are long and they have very low risk, okay? That's if you're directional, okay? Now, what if you're not directional? What if you're just volatility, looking at it from a volatility basis? In that case, you could combine the two. For example, you could do the 2879 that expires at 11 a.m. and that would be a short and it has $14 of risk. Okay? And you could do the 2949 binary that has 1675 in risk. Does everybody understand that? The only thing that you need is for the market to move. Any questions on that so far? In this case, if you're doing a volatility-based trade, what your probabilities are coming from is that the market is going to move, okay? Now, personally, I like to enter right before the market report is going to be released. Now, you can see that most of these I entered between 8:30 and 9 o'clock, okay? Typically, when I'm doing a volatility-based trade, I like to enter right before the market report. So in this case, if I was coming in right before the market report, I could look at the USD CAD, again, choosing the 2-hour binary, okay, and say, okay, what is a low risk trade setup that I could enter that potentially would make money this morning? And again, it's potential, okay? Nothing is guaranteed when you're trading the market. And in this case, price is currently at 29.11, and you could actually do the 29.79 short, or you could do the 28.89. Okay? Now notice that there's only $18 of risk on that particular trade. Now that's the short side. What about the long side? Again, this is going to be about controlling risk. And in this case, we could go in and do the 29.39 at 16.25. What about if there wasn't one that had a low risk? And this is really important to understand, okay? You only have a maximum profit of $100 on a binary, okay? So if your risk is $80 between the two, then your profit potential would only be 20, okay? In this case, we have the 89 and we have the 39, okay? So you've got, between the two, you have roughly about $18 on one side, $16 on the other side. That's $34 of total risk. Does everybody understand that? So you have a potential to make 66, okay? That's your potential. Now, I always put in a profit target, okay? And in this case, I'm going to set the targets where you can capture all but $10 of potential profit. So in this case, my profit potential would be a maximum of $56. Does everybody understand that? So I'm going to go ahead and I'm going to click on the short and I'm going to set a $10 target. And then on the long position, I'm going to set a $90 target. Now, what if you could not find suitable binaries that have less than, I like to limit it to $40, okay? Well, you could also go and say, okay, I don't like the risk on the longs, so I'm going to go and look at the longs on the spreads, okay? In this case, 29.10, you're looking at $33 of risk. Does everybody understand that? I'm sorry, it's $24 of risk. Does everybody understand that? What question do you have? What part do you not understand? And remember, the spread is only limited by either the floor or the ceiling. So you have the potential to make more on the spreads, but the binaries do have a limit of $100 maximum payout. The risk potential on a spread, okay. The risk potential on any spread, if you're going long, okay, your risk is limited from your offer price on entry minus your floor, okay? But if you're going short, then you are limited by the bid and the ceiling, okay? Now, how are spread profits calculated, okay? It's $1 per pip, okay? I've had a lot of questions about that recently, but it's $1 per pip, okay? Notice on the prices, on the bid and the offer, it does not show the half pip, okay? It only shows the last 4 digits, okay? And you can combine the dailies. You know, you have 6 dailies on the forex. You could combine the 11 a.m. with the 3 p.m.s. You could combine the 11 a.m., the 3 p.m., the 7, and the 11 p.m. Okay, you can stagger these. I've done that before where I might go in one direction at the 11 a.m. and another direction for the 3 p.m. There's so many different ways that you could do this. You can also set targets on the spreads, okay? For example, this is a short, okay? And the floor is at 26.50, okay? The entry price was 28.76. So you could come in and say, okay, if this goes down to 2,800, I want you to take me out, okay? Again, that's a short. This one is a short from 29.10 to 28.10. You could also come in here and say, okay, if this goes down to 28.25, okay, remember you're short. You want it to be lower. And you can see the price right here where the entry was. Then you could say place order. Again, this helps if you have a very strong volatile movement, then you could potentially come out of those spreads. You can do the same thing on the longs. Again, just put it right underneath and say, okay, I entered at 29.35. So let's say if this goes to 3,000, okay, then I want to be out of the position, okay? The same thing on the next one, okay? And again, 29.37 was your entry point. 30.10 is the highest that it will go. So if you just set a 1.3 thousand for a profit target, okay, provided there's enough buyers or sellers, depending on whether you're long or short, it could potentially bring you out of these positions just because the market got there, okay? And there was sufficient buyers and sellers. Does everyone understand? And normally these trades do not last a long period of time. You know, typically you're out of this position within 15 to 30 minutes, okay? And just because you have profit targets does not mean you do not monitor your position. I still monitor the position. Notice that I have red lines here that shows me where my shorts are. I have blue lines up here that show me where my long binary positions are, okay? And I do tend to watch the chart more than I watch the actual positions that I'm in. Now, sometimes you will have to go in if you notice, okay, they're not going to hit this target, so I'm going to try to get out early, okay? Don't make the mistake of clicking on your open positions, okay? If you decide to modify an order, I suggest that you do it from your working orders because you may forget to cancel that order, okay? And if you don't cancel the order, you could actually get filled at a price you don't want filled at. Does everybody understand that? And this is why I have it open in 2 separate windows here, because I can say, okay, this is a binary, so I want to come out of the binary and I just look for the strike price down here. Any questions while we're waiting on the market report? I love trading the market reports. It has to be a high volatility report for me to trade it. And this is something when I was trading forex, I was never able to do, okay? Because you don't want that much exposure. I mean, it can get quite volatile. So I never traded the market reports. But with binaries and spreads, I can do it. Only because it's a limited risk environment for you. Okay, I'm new. How do you cancel a working order? It's very easy. Let's say that you wanted to cancel this one on 2960. All you have to do is click on it and say delete remainder. And as you can see, it's no longer there. I'm going to actually go in and put it back on. And this is something else I do just as a precaution. I go in and I say, okay, I've got 4 spreads. Do I have working orders on these 4 spreads? Well, you can see that I do. Then I'll count my binary options. I've got 3 short positions here. It's 2860, 2879, 2889. So I come down here and say, okay, do I have the same number for the same strike prices? And I do. So I kind of check that off. And then I say, okay, do I have working orders for my 3 longs? 2939, 2949, 2960. In this case, I do. And I just do that as a precaution just to make sure, okay, I'm in these open positions, but I also have all of my working orders in as well. The 2960, no, if you're doing a working order for 2960, remember you're long. To come out of that position, you have to sell, not buy. And so you put a sale price at 90, okay? If you do another buy at 90, it is going to add to your position. Did I trade the Canadian trade report from earlier this morning? No, I did not. And the reason that I did not, David, is typically you get about a 45 pip move off of that, with the exception of the day that the Bank of Canada coincides with that report. Then you will not get as much. And I think this morning it was maybe 20 pips. It did not move a lot this morning. This red bar here highlights the move this morning on that. And it went from a high of 32 down to 29.03, maybe about 30 pips. But also remember, this came out, well, it was this one, I'm sorry. So it was 29.31 to, yeah, that's the one I did. It was about 30 pips. But also remember that you would have to use the 2-hour binary, which just opened at 8 o'clock. You know, I like to get the ones that have a little bit of time decay kicking in on it. In other words, maybe an hour left, because then if it does move in your direction, you get better pricing is the only way I know to put it, because you've got time decay kicking in. You know, it's worth less. If you're going out of the money, the price is going to be cheaper when it's 1 hour left versus 2 hours. because, you know, the probability of it going in the money, if you're using an out of the money, is less as time progresses and it's not moving in your direction. Does that make sense to you, David? It's one of the reasons that I usually enter about 10 minutes before the market report, just because I know the time decay's kicking in, which means I can limit my risk even further using an out of the money binary. And when you're doing volatility trades, it's all about what your risk is. You know, a binary that has 30 minutes until expiration or 40 minutes until expiration is going to be cheaper using an out of the money versus having 2 hours left because you have more time. Let me see if I can find any of them right now. Okay, this one. Okay, right now your at the money is right here at 29.19. Okay, do you see how one strike out is 31, 35 on the short? All right, let's go over to the daily 3 p.m. Okay, and this one, let me expand this. This is your at the money 29.18. Okay, your 39 one strike out and just about 40 one strike down. It's just slightly cheaper on the 2 hour with 1 hour left, just about 1 hour. On the 10 a.m., you know, you could get one strike away for 2 minutes at 17, and this one at 15. It just shows you how the time decay works in your favor, because it's also dependent how fast can price get to a certain area. Okay, that was my point. Not sure I made it very well, but that was my point. It's always a measurement of time versus movement. Okay, the closer to expiration you get, the lower the risk is on an out of the money. Okay, at the money it gets more expensive. Out of the money it gets cheaper. And again, you could lose on every one of these, okay? If the market does not move, okay, you could lose on both positions. And they're not expected to raise the rates today. It's agreement. Nobody expects them to raise the rates because they've had some bad market reports lately. Does that mean they won't? No, it doesn't. It means they'll do whatever they want to do, basically. And that's true of any market report. You know, sometimes they do exactly what we anticipate. The market moves exactly as we anticipate. That's when you do the directionals, okay? But most of the time during market reports, there's a lot of surprises in there. So all you're doing is saying, okay, I might have a bias to the short side here, but I realize that the market can do whatever the market wants to do, and therefore I'm going to do some long positions to cover just in case they go against me. And quite often they will go against you. And today it may take just a few minutes for it to move because I think they're going to be looking at what they say versus what they're doing. In other words, not as much about whether they raise the rates, but about what they say. Are they going to continue to raise rates later in the year? Or are they just saying, no, we're going to hold off on any further rate announcements? And notice that I'm not going out looking at what they decided because it doesn't matter. I like that, Ross. It's not the report, it's how the big dogs react to the report. And it's very true. It truly is. And I think overall this morning is going to be more of a matter of what they're saying versus what they did. And I don't really care what they did. All I care about is how they react. And you can see there's not much of a reaction right now. Is the rate announcement broadcasted live or is it something we read up on after it's released? I'm sure if you're in Canada, they have a news channel that's covering it. You can also go to Forex Factory and it will tell you what the release was. Let me see if I can bring that up for you. Yeah, you also have crude oil inventory in 30 minutes. I think right now they're kind of listening to what they're saying and trying to figure out, okay, what does this mean? Because nobody anticipated them to raise the rates from what I was reading. No, I don't like to trade the crude oil inventories when there's a Bank of Canada. You've seen me trade the Bank of Canada, the US CAD on crude oil inventories, Patricia, but I don't base my trade on crude oil inventories on the day that there is a rate statement for the Bank of Canada. So you can see they did exactly what was anticipated. They kept it at 1.25%. Okay. So now it's a matter of, do they give any clues as to whether they're going to raise the rates later in the year? That's what they're trying to decipher. And that's why you've seen this has not moved very much. Not even a full 40 pips. You've had about a 35 pip movement. But again, like John said, you've always got the crude oil inventories. Is that going to be the straw that broke the camel back? We don't know. And I mean, most of these positions have another 55 minutes. A couple of them have just about the entire day to move. You could go in and start exiting positions and say, oh, I don't really like it. But again, they're trying to decipher, whether they're going to raise interest rates later. I'm okay with $200 of risk on all of these positions, okay? But that's something that you have to decide. Do you mean these colored boxes? That just tells you what the market report is about and historically when it has been released. Okay. The one that I use more on Forex Factory is the expected impact. When it's a red report, normally those are the ones that I trade. And you can have it where it has any of these listed. So, for example, if I take that off, you see we had a lot of red and oranges, which I don't even pay attention to because they're not high volatility. Okay. What I like to see are just the high volatile. That's the only time that I do a volatility based trade. Does that answer your question? And again, if it stays right where it's at, if you look at this, it's 29.16. Okay, 29.49 is my first binary. Okay, 28.79 is my first short binary. And as it looks right now, it's not going to get to either one. Again, you can always lose on all of these. Now, on the spreads, I really don't try to manage them too much. The reason that I don't try to manage the spreads as much is because it's variable, okay? In other words, right here, my price is 28.76, okay? And I'm short. Well, if it expires, let's say at 28.80, okay? Then I don't lose the full risk amount anyway. O'Neill, I'm not sure what you need to do on that one. Does everybody understand that on the spreads? On the binaries, it's very clear cut, okay? If this was to get to 28.60, as long as it is 1.2860 or less, I could potentially make money on that. Not so on the spreads. It's really dependent on where the indicative is. If it's above 1.2876, yes, if you're short. So for example, my entry price on this short, and it tells you here it's short, okay? If it expires and the expiration price is let's just use the price it is right now, 1.2918, okay? Then I would have realized a full loss, which is basically $24, okay? But what if the expiration value is 1.2880? Okay, then I've only realized a loss of $20. Does that make sense? The spreads are not all or nothing, okay, like the binaries. You're really looking at expiration value. I like both. It just depends on what I'm doing. What type of movement am I expecting? Michael, he was asking if it fell above 1.2876, are you at a loss? But again, it's dependent on what the expiration value is. And, you know, a better scenario is like on the long position, okay? My entry price was 1.2935. Okay, the current price is 1.2914. Okay, so instead of having a $35 loss, if it expired right now, I would only have about a $10 loss. In other words, the other $25 would be returned. Does that make more sense? With the spreads, it's really dependent on the expiration. If it expired at your entry point, would you break even? No, because you still have the risk there. Okay, you can see right now, okay, at 1.2935, okay. Any other questions on the spreads or the binaries? Do I have a webinar on spreads? Yes, I've done several webinars on spreads. If you go to the nadex.com site, if you go to the Learning Center, click on Webinar Archive. If you filter by Traders Help Desk, then there's a lot of webinars I've done on spreads. You know, why spreads and the benefits, advanced strategies for spreads, what you need to know about trading forex, binary options, and spreads. There's a lot of them there on spreads. Normally, the earliest that I enter Bank of Canada rate announcement, Jason, would be about 10 minutes before. And the reason is, you know, you want to be as close to price as you can possibly be. Oh, thank you, John. Sometimes when you enter, the earlier you enter, the more likely you are away from price, okay? Because normally right before a market report, we get that little bump of movement. And so you won't be as close to price as what you need to be. Do you understand that, Jason? And again, this is a good example. If you have been directional, okay, let's say that you did the short at 28.60 because you believed it would go down, okay, then your risk was about $17, okay, and that's all you lost. Okay, in this case, we are both long and short, okay? So we have risk exposed on both sides, on the longs and the shorts, and you can lose on both sides, especially a day like today where it's just not moving. In other words, they don't feel like they got any clues as to what they're going to do. They didn't raise the interest rates, and from the looks of it, they can't decipher whether they're going to next time or not, so it's not moving. Could the crude oil inventory report come out and change it? Sure, it could. It's being released in about 12 minutes, and that very well could create additional volatility that will either move it up or move it down. And also remember, we have non-farm employment on Friday. Just gives you another opportunity to do a volatility-based trade. And we'll be doing another session on that one Friday morning. I believe that one starts at 8 o'clock. Generally, the ones that I have researched that do not move the markets are the ones typically during the summer months. You will not get that many moves. You know, if you're expecting 80 pips, you'll be lucky to get 40. How many market reports affect the Canadian? Actually, quite a few. You've got the unemployment rate. Generally, the trade balance will affect it. The Bank of Canada, the crude oil inventories will affect it. What's some of the other ones? Let me look it up real quick and I can tell you. Which pairs do I trade on Friday? Any of them that are USD based. Let's see. The US CAD reports would be trade balance, the IVPMI, the unemployment, the manufacturing sales, the Bank of Canada, the core retail sales, or the GDP. All of those will affect. Now, the IVPMI, I do not trade because you don't have enough movement there. And I don't trade the manufacturing sales because there's not enough movement there. Those are the two that I just don't really care about trading. I'm doing a new book now on market volatility that will have that included in on it. Are the markets typically slower during the summer because people are on vacation or another reason? You know, that's a hard question to ask or answer because you really don't know. I presume it's because people are on vacation. But would I know that? No. When will the new book be released? I'm thinking probably the end of April or the 1st of May. I'm updating all of the market report data, and that takes quite a long time to do. You know, Kevin, you asked which pairs to trade on Friday for the non-farm. You know, anything that's USD based is probably going to move. Can you get updates from the website? If you're on my mailing list, you would be updated as to when the book is going to be released. Which currency? Non-farm employment. Let's see, the Aussie about 59 pips, the Euro 78, British pound dollar 64, US CAD 84, USD Swiss franc 62, USD JPY 84. You have some real significant movements on that. And I've noticed that the euro dollar doesn't quite move as much as what some of the other currencies do. And if they come out and it's a surprise, oh, it's really good then. And all of those historical averages are based, I did that report in 2015 and I'm updating it now. And I'm actually thinking about using a new average for it that gives more significance to the last few reports versus the older reports. Now remember, I said you could have exited all of your positions and kind of scrapped them because you said, oh, it's not moving. Do you see how long it's taken for this to move this morning? And notice that you're very close to being filled here. This is why I don't try to micromanage a lot of these. I just go ahead and let them work, okay? This is what I call the delayed reaction, okay? But notice that, okay, here you've got $17 of risk, okay? Here you have 14. Here you have 18, and this is on the binary side. So if I wanted to make sure that I covered these losses, I would just exit this one right now. Do y'all see that? Over here, you had $24 of risk. Here, you had $23 of risk. You're slightly off from a break-even point on your long spreads. Do y'all see that? The reason is because we're looking at risk, okay? That's really what we're looking at. We're not trading technical analysis. We're not trading probabilities. We're trading, okay, let's keep the risk low so that I can recoup any of the potential losses and still make money. Okay, if it's red, it's bearish. If it's blue, it's bullish. That's how you distinguish between a bear or bull position. These are all bearish. These are all bullish. Okay. Oop. And for example, okay, the 29.39. Okay, if you come in here and say, okay, I want to cover any of these potential short binaries that have not made money, you can just click on here. That modifies the order. Click amend order, and that would amend your order. If you notice, this is very close to being filled, has not been filled yet. It's close, not there yet. Now it's been filled. So you know that your short positions are now covered, okay? And this is where you can say, okay, you know, this is a little bit too close for me. I want to exit the $60 strike, okay? Again, all you would have to do is click on it down here, modify your order. Notice that these two have now covered the potential losses over here, and you're still in the money. As time gets closer to expiration on the spreads, does the price move faster? It depends on what the underlying is doing. If the underlying is moving, then, you know, chances are this price over here is moving. It's just really dependent on the underlying for a spread. Notice how this price over here, $29.75 of 74, is correlated to this price over here. That's what you're looking for. Okay, we just had another one filled. It was filled at the $90 target. So we have one remaining. And again, you know, you can look at this and say, oh, that's just too close to my $60 strike. And it's 29 minutes, okay? You can just go in here, click, and just go ahead and amend your order. And as you can see, I just took profits on it, okay? Now, you can also do the same thing on the spreads, okay? One is until 3 p.m. today, okay? Do you necessarily want to exit that? That's a decision you have to make. If you see that this is going to come down in the next 30 minutes, okay, you might say, oh, no, I'm going to go ahead and take that because at least it will cover my short spread. Not that you made money off of it, but it covered the spread loss and potentially covered your exchange fees. Does everybody understand that? Could you leave them and say, hey, this has the potential to go up another 30 pips? Sure. Any questions? And again, this is more about risk management versus, you know, your technical analysis. Because when you're trading a market report, technical analysis is not going to help as much as being able to manage your risk, in my opinion. Any questions? So did we have losing trades today? Sure, we had losing trades. Okay. But we still came out ahead of where we started. And we didn't even have a bias to it. Any questions? All right. Remember, Friday morning, we will begin at 8 o'clock with non-farm employment. Okay? Everybody have a wonderful day. O'Neill, I am observing the amount of positions you have open. Is it better? I don't understand your question, O'Neill. All right. Everyone have a wonderful day. And I'll see you Friday morning at 8 o'clock. You're new, but usually have 3 or 4 on at any one time. You could have just had 2 on, a long and a short. The number doesn't matter. What matters is that we had both long and short positions on. So either way that it potentially moved, we would make a profit. Okay, everybody have a wonderful day, and I will see you Friday for trading non-farm employment.